What's going on, best ever listeners? This is your host, John Casmon, and we are here for Multifamily Mastery. I'm super excited to talk to today's guest, James Faillettaz. But before we bring him on, I do want to let you guys know, February 18th through the 20th, Salt Lake City, Best Ever Conference X. That's right, the 10th year of the Best Ever Conference. We're going to be there live, and I would love for you to join me for the event. It's going to be a great time connecting with other real estate investors looking to scale their portfolio. So make sure you get your ticket for the event. We'll put a link to that in the show notes. But right now, let's bring on James Faillettaz. James, how are you today?
Doing well, man. How are you?
I'm good, man. I'm good. Listen, I'm excited to chat with you. Why don't you give our listeners a little bit on your background?
Okay. I'll do the kind of abbreviated elevator pitch, but I was born in a small little mountain town in Colorado. Parents moved out of there pretty quickly due to economic opportunity, moved up to Minneapolis, spent most of my life growing up in Minneapolis, lived in the panhandle of Florida for a brief stint, but didn't last long. And then got the opportunity to travel quite a bit between the ages of 18 and 22. Ended up at a college called St. Olaf College, a small little liberal arts school in Northfield. And then for the past 5.5 years, I have been growing a real estate business.
Yeah, man, I appreciate that. Just growing up, being born in Colorado, moving to Minneapolis and moving a little bit to Florida. But you're in Minneapolis now. You said you're growing your real estate business. Tell us more about the business and what you focus on.
So I graduated college about 5.5 years ago, and I had 5 units in a spreadsheet, and I made the executive decision that if I didn't get a Fulbright to move to Ethiopia, I was going to start a real estate business. I did not get to move to Addis, so I decided to jump right in, moved in with my mom into a duplex, and just kind of started soliciting the sale of capital of my business. Eventually found somebody, I had an IB and PE background, so I kind of took that route.
You got to explain. What does that mean? You had a what?
Investment banking and private equity background.
Okay.
So that's what I went to school for the first 3 years of college. So I thought, I was going to be PayPal. So I'm selling shares of the holding company, which is really just 5 units in a spreadsheet, at equity multipliers because of the growth rates and this and that. And I really, probably should have just been carried interest, but I got a little sophisticated and had fun with it. Long story short, sold about 25% of the company and started growing. We did the classic kind of BRRRR strategy. We bought 20% down, 2 to 4 unit multifamily, added finished square footage and rehabbed the kitchen and the bathroom, and then pulled capital out. And we did that for about 1.5 years, got up to roughly 16-ish units, if I'm remembering correctly, sold equity again, and then got up to about 32 units. And at this point, we had grown big enough where we had a property management company, we had a construction company that was doing a lot of our work on the value add, and we had kind of pulled out this investment company. But like you and I were talking about earlier, I think I got a little bit over my skis. And I had 32 units and I want to say 12 employees. So, yeah, wow. It was a little bit of a mess.
All right, 32 units, 12 employees. Sounds like we got to rip the Band-Aid on this story and figure out what happened there. Before we jump into that, though, I want to get a quick word in from one of our sponsors. All right, James, you have 32 units, 12 employees. That's got to be the craziest ratio I've ever heard anyone say on this show. There clearly is not enough cash flow coming through at 32 units to even come close to paying for 12 employees. Why did you grow so fast? What happened?
Yeah, I think it was being a little bit delusional and having that corporate startup background a little bit, where I thought, in the beginning, I thought I was going to be the next PayPal. Okay, we're just going to be in crazy negative cash flow, but we're going to keep on getting these large investments. We're going to keep on growing our kind of enterprise value by 30 to 60% a year, and everything's going to be great. We're going to be like Amazon. We're going to be non-profitable for 38 years and then be worth, $1 trillion. But I was younger and dumber than I am today back then. And, the legal structures weren't set up right. And I kind of realized there was no dilution of equity clause or things like that. And I was just kind of going to indefinitely have to sell the share of the company that I owned forever to keep growing. So I joined a mastermind, met some people that were smarter than I was, and really started to heed their advice and basically tore the whole thing down. Went through a restructuring process with my investors at the time where we packaged all of the assets into a fund, and I gave them the majority of that equity back in the fund. But then I got full control of the operational companies. And in that time, I really only could employ 2 or 3 people. We just had a property manager and, a leasing assistant, and all construction has stopped, and a maintenance guy. And I became a real estate agent to subsidize my income because I was no longer taking salary either. So fast forward about 14 months, we actually sign on the dotted line. There's now a grouping of properties, and I own a lot less equity of that today, but now I own all of the operational companies 100%. I'm ready to kind of jump back in and start growing.
So everything was really one company starting out, right? So when you had the 32 units, the construction, the property management, everything was under that one company, and the investors owned shares of that company. That was the structure as you kind of set it off. Yeah. So how did decisions work, right? If they had shares, were you kind of the managing member of that company? And what I'm getting at for our listeners is, obviously for those of you who invest in either JV deals or syndication deals, typically there is a separation on who's making decisions, who's operating, and who's just investing money or who's a passive investor. With the structure you set up, you've got shareholders in the active company. So I'm curious, who had decision-making power, and, when you're hiring these employees, how are those kind of things managed in the process?
Yep. So the investors were strictly LP investors.
Okay.
They didn't have, they had very bottom line rights. So if we were going to acquire, if we were going to sell, there was a vote. But other than that, I had all of the control because, I was the one actively growing the investment. They had other jobs. They were doing other things. So that's kind of how the breakdown of control worked.
That makes structure. Sense. James, talk to me about when you realized that there was a problem with the structure of the deals.
I think the tipping point was actually we had this really awesome property under contract. We bought this 5-plex in 2021 for $375,000. We got the bank that we had worked with quite a bit to give us a construction loan. We had $170,000 in construction. So 375 plus 175, we're going to be all in at 540. And we think the property is going to be worth $1 million after we refinish the basement and make the 2 bedrooms into 3 bedrooms. It's my best project to date. And we're delegating improperly. I'm probably leaning into being the CEO a little bit more when I should have just been managing the construction project, because it was the whole company at that point. If we get this to go right, this is the biggest thing we've ever done. And we got robbed by a contractor for $90,000. And, our grand slam, we were able to salvage it, but I was there, running around in my truck, picking up the materials. I'm doing some painting. I'm hiring people off Craigslist to help me just, install a cabinet or this and that. And our grand slam turns into a base hit. It doesn't fall apart, but we don't refinish the basement, and the property appraises at $620,000. So we still make some money, but it was a disaster. And we borrowed private money on this, and it was oh, so things can go wrong. And if things go wrong, the buck kind of stops, and I need to go sell my equity share to have more cash in the business because we're negative cash flow. And it was just kind of this aha moment where then I started talking to people, And they were like, what you've done is awesome. Like you've raised a bunch of money. You've made stuff happen, but you've gotten over your skis and you've set up your structure all wrong. Like you're not a startup. Like you're doing cool stuff, but like you're not like reinventing the wheel.
Yeah. You talked about the dilution of equity. And just to recap what you were just saying, you had this deal, supposed to be a home run project, rented some issues where contractor steals 90,000. You still are able to manage the project and make money, right? You had to do it differently. You had to roll up your sleeves and get heavily involved, but you make money. But you realize that, man, the structure is just off. The dilution of equity, because what you're saying is you had to go out and sell more shares to raise more money versus, again, the way most folks syndicate now, everything's on a deal by deal basis or it's in a fund. So it's never the full company. But in your case, it was the company. So you had to give up more equity. How much money had you raised at that point, and how many shares, I guess, had you given out to investors?
So, and like I said, I was great with numbers and I was somewhat a little delusional and had that charisma to pitch. So I had raised about $750,000 and I had given up, at that point, I owned 78% of the company. So I had sold 22%
for a $750,000 valuation.
Yeah.
Okay. So,
and
okay.
I mean, people were buying in on 3, 4, 5x multipliers because we were growing at 30, 40, 50. And like, if a company on the stock market is growing at 50% per year, like the equity valuation goes up. But I'm a 23-year-old kid in St. Paul. So yeah.
What lesson did you learn about deal structures from that experience?
Thinking back, I think there's a couple things. And there's this quote that kind of lives in my head, and it's like, do the hard thing, make your life easy. Do the easy thing, make your life hard. This was kind of the easy thing. It was like, hey, we're just going to keep on growing. I have autonomy. I get to like make all the decisions. I get to get all this money and all this equity up front. This is great. And like the hard thing might have been like, okay, do better underwriting, do like an 80-20 carried interest model and an 8-pref, like on a deal by deal basis, have individual legal docs for every single building, and like, take less of the equity yourself, but have, a structure that's going to last through time because it's tested and true. And, do I sometimes think, okay, maybe if I would have done this different or like had better legal structures? Yeah. But at the end of the day, I think the biggest thing that I learned is like real estate has been going on for a very long time. You don't really need to reinvent the wheel to do really, really well.
I think that's an important lesson to learn because it's great to have new ideas, and certainly other industries have new ways of doing business that the real estate industry could learn from. But there is a slow to adapt component with real estate, and some of that's there for a reason. So to understand why things are done a certain way certainly helps. Talk to me about that transition, right? You mentioned you got into some masterminds or started to get around some other investors, and that really helped you learn of a better way of structuring your deals. Tell us more about that.
Yeah. And I'll caveat that, real estate has been around a long time. Like you don't need to reinvent the wheel to do well. We're still probably more creative than 98% of, companies out there, because that transition, the next, 12 months, I was able to acquire 101 units on master lease with purchase options for zero money down, like, which is again, less reinventing of the wheel, but like, it's still not conventional. But we'll jump into that a little later. Yeah. So I was able to join a group called GoBundance. I, kind of through a happenstance or serendipity, the banker that I had worked with a bunch was like, I just talked to this guy and I think you'd get along. And I was like, okay, cool. So I reach out to him and he's like, yeah, we can jump on a phone call. Here's my Calendarly. Book a 7-minute phone call with me. And I'm like, who is this guy? Book a 7-minute phone call. Like, just call me. Then I started looking him up and I was like, oh, his name is Nick Stogberg. He runs Black Swan Capital down in Rochester, Minnesota. And he's kind of become a really good friend and mentor to me over the years. I'm incredibly happy that I met him when I did. And he's done incredible things with his organization. He gives back like nobody's business. And he's gone from 20 single family houses in 2019 to about 2,500 units today. And it's just an incredible journey that I've been really fortunate to be able to have like gotten to witness some of that. But long story short, we had a great call and he was like, what are you doing next Tuesday? And I was like, I'm just going to work. And he's like, come down to Rochester. And I was like, okay, sounds good. So I'm with him in Rochester, show up early, and he's like, what you've done is really impressive, but it's all wrong. You should either sell everything or you should restructure your company. And I had been kind of thinking like that, but when somebody that I looked up to was so blunt and so willing to be like, you're smart, but you're dumb. Think about your life differently. I was like, okay. So then go through the transition, start talking to the investors, have these hard but necessary conversations. And we eventually, after 14 months, aligned that we were going to restructure everything into the fund. At that point, I had started a real estate agent business to kind of like keep income coming into the table. And we, I don't remember the exact date, but when we restructured the fund, I was then able to like truly feel like they didn't kind of have that ownership in everything I did in real estate into perpetuity, and kind of started to really push from there.
Yeah, I think that's so important, man. You talked about just having some ability to make decisions, drive the business, drive the operational side while still doing right by your investors. I think it speaks a lot about yourself, right? To make sure you took the time to do that. If it took 14 months, that means you didn't just say, all right, guys, hey, I'm selling everything and, here's your cut and buy. So you actually took the time to reframe it and say, okay, how can we restructure this so it works? But also putting you in a better situation to grow and to be incentivized to go out there and do what's best for the business. You mentioned this mentor. I think it's so important, right? Just we come across people all the time, and mentors can help accelerate your growth. They can help you see things that maybe you miss, or like you said, you're on the fence. You're thinking about it. I kind of want to do this, but a mentor can come in right away, see it, and just tell you, do that, don't do this, right? Or you're messing this up. And it just gives you the clarity that you need. You mentioned, I think you met this person in Go Abundance. How did you get involved in that in the first place?
So I actually, funny enough, I met him outside of Go Abundance, and I asked him, hey, I'm looking for a mastermind or a group of people that I can put myself around to help me grow. And he was like, hey, join Go Abundance. I had never heard of it. I didn't know what it was. And because of my 2 to 3 interactions with him at this point that were like, wow, this guy's, something different. Yeah. I'm just going to take his word as bond and do it. And I've been in for 3.5 years now. And it's, fairly expensive to stay in, but like, just by me meeting Nick and meeting a couple other people and restructuring my business, it's paid for itself, 100 times over at this point. So
how did you meet Nick initially? Let me say that again. That sounded weird coming out. How did you meet Nick initially?
Yeah. So really serendipitously, a banker that I had worked with to help me build the first kind of portfolio, Nick had reached out to him and they were working on a transaction, and the banker kind of out of the blue, he had never done this with anyone else, but was like, I had a long conversation with Nick and I've talked to him over the transaction and I've known you for now, like a little while now. I think you should reach out to this guy and I really think you guys would get along. So just, through a random connection with a banker.
And the reason I call it out, it's interesting, right? Because it can feel random, but the truth is you displayed something with that banker, and you're 24, 25 or something like that at this time, right? Mm-hmm. So you're a young guy, that they see taking action, making moves. You've got this other guy, Nick, that the banker has a relationship with, and he probably recognized that, hey, this person may be able to help you continue to grow on that journey. And it's so important because sometimes we don't know where the help is going to come from. But if you're taking action and you're showing up and you're putting that out into the universe, there are people who are taking notice, and people generally want to see you succeed, and they will help you. And sometimes we may brush that off and miss that opportunity to connect with someone that can help us elevate our investing or our life. And sometimes we actually recognize that opportunity and go. It's different, but it's similar to how I met my mentor, right? So Joe Faillettaz is a mentor I got to know, founder of the Best Ever Network. And I met him through a similar way. I was just trying to connect with people in Cincinnati, and I was on Bigger Pockets, and I was just posting, and I was saying, hey, I want to network with someone, investors in Cincinnati. Is anybody open to meeting? And a bunch of people just tagged Joe Faillettaz. And I'm like, hey, man, I made this post. A bunch of people tagged you. Are you open to meeting? And he said, yes. And from there, I learned about, what he was doing. And this was almost 10 years ago. So it's crazy how these things happen. But the message I want everyone to take away is it starts with action. You can't just be sitting in your room waiting on the phone to ring or the email to come through with a great opportunity or some wonderful person to take you under their wing just because you're a nice person. You got to take action and put it out there. You have to be hungry and looking for deals and looking for opportunities. And then folks are willing to say, hey, make a left here, or don't go down that street, go down this street. And they can kind of guide you down that path, but you have to take action. Even if you're taking the wrong action, which in this case, you structured your deals wrong and had to take a step back, but it's probably a lot easier once you already have these investors in place. They've already committed to you on the deals. They were making money with you. Way easier to have a conversation about restructuring than selling them on this idea and concept in the first place. So I just think it's so important to take action, because so often people don't take action because we make up all these stories of what could happen and rejection and all these things that we put into the universe, or really put into our heads, so we don't put things into the universe. And we stop ourselves from taking action. It's just so important to do that. So I really appreciate you sharing more of that story. Now, you started saying that you were doing these deals now. Once you kind of got some coaching from Nick and started realigning, you bought 101 units, really through master lease agreements. Talk to us about that strategy and how you utilize it.
Yeah. So, again, I want to say luck, I want to say serendipity, but I think to follow quickly off of what you said, I had a long conversation with a couple friends one night, and it was this idea that you kind of got to create your own luck. And we kind of landed on luck is when preparation meets opportunity. So you have to get the opportunity, but if you're not prepared for it, it's going to pass you right by. And sometimes you can be super prepared for it and you're not going to get the opportunity, and that's just life. But, luck is truly when you're prepared and creating that preparation, even if you're doing it wrong. But then opportunity comes along, and it's just kind of this beautiful synergy. So leading into that, I had been in GoBundance for about 6 months now. I had gone to a national conference. I had met these two guys out of LA, and I was like, I'm so good at multifamily. I had never bought a true multifamily deal, but I had a lot of confidence. So we find this 18 unit. I do all this underwriting. I have my investment thesis. I own the construction company. We're going to go in. We're going to remodel every single unit. We're going to switch everything to subsidized housing because there's a delta between market rents and subsidized housing, and we can be really strong providers in that space. And we have a tenant success coordinator, and we're, that's kind of where I grew up. So I know the space and yada, yada, yada. And they said, yes. They were like, okay, I think we can put in all the capital. Your underwriting looks good, So we get the deal under due diligence. We're kind of marching forward, and, I think they kind of start to see he doesn't actually know what he's doing. It took me a little while to get the insurance, and they're like, did you get the insurance? And I was like, yeah, we're getting the insurance. And we're 15 days out from closing. And they're like, you didn't get it yet? And I'm like, no, we got a quote in. And they're like, it takes a long time to get insurance. So it was a learning process for me too. But my underwriting, boy, those spreadsheets always look good. In the beginning when I was selling equity for this deal, like I have that math background and I'm able to produce those spreadsheets. Long story short, at the 11th hour, these guys are like, hey, we really like you as a guy and like we believe in you and you're smart, but like we can't do this deal with you. We gotta back out. Like we'll pay for the legal docs, and we'll pay for the inspection, but like we gotta get our earnest money back and we gotta back out of this deal. And I'm like kind of devastated. It was gonna be an 18 unit. I was the agent, so I was going to get like the biggest check of my life, and so many things. And it was tough. But throughout this process, I had formed a relationship with the owner of the building. And he was like, you really think you could do what's on your underwriting with this deal? And I was like, 100%, because I really did believe it. And he was like, if I was able to kind of potentially get you into another deal through like maybe a contract for deed or some kind of creative financing, would you be open to that? And I'm like, hands down, 100% yes. So I create another beautiful scheme. Like every unit I renovate, I get 2.3% equity and we dilute the LPs and this and that. And, I pitch it to my GoPod and they're like, this is ridiculous. Here's a lawyer. Go talk to her. And I bring this scheme to her and I'm like, how hard do you think it would be to create these legal docs? And she was like, well, you would pay me a lot of money and it would be really, really hard. Why don't you just do a master lease with purchase options? And it's the same exact thing. And I was like, it's a pretty good idea. So we dropped master lease with purchase options. And that was kind of like where it started. I got a 17 unit under contract. I'm paying like PITI and I'm giving the investors back a 30% return on what we believe their equity to be from day one. And I'm the agent, so I'm waiving my agent fees. And there's a couple other nuances that maybe I don't give away 100% for free, but there's a couple other nuances in the structure. But more or less, March 1st, 2024, I take over Maryland Apartments. It's 17 units and it's completely free. But let me tell you, the guy that I met, he cherry picked one of the worst properties in his portfolio. And he said, if you can do it on this one, then, then it's probably worth it to try and give him another shot.
There you go. So for our listeners who maybe have heard the term master lease, but maybe aren't as familiar, I want to break this down a little bit more, right? So the way you structured this deal, you kind of lost out on your equity source. So they backed out. You had to get a little creative. The owner said, all right, listen, we can do this structure here. It's a little bit creative. So you go into a creative financing conversation. You do a master lease agreement. You're only paying, for PITI. Your investors are getting 30% equity or 30% return on their equity or what you believe to be the equity is on the deal. And you're going to go in and execute the business plans. Talk to me about the master lease. What are you on the hook for? There's an option to buy. So just explain that for our listeners.
Yeah. So bare bones, I'm leasing the whole building. And to lease the whole building, I have to pay principal, interest, taxes, and insurance. And assume all of the utilities and maintenance and repairs and large CapEx items. And there's some contingencies like, if a boiler blows up and it costs $50,000, we split it with the LP group, or there was some negotiations there. But for that, now I have two things. One is I get all revenue from the building. And that's the key. Revenue wasn't great, but I knew that I could get it to somewhere a lot better. But the most important point of the deal is I get a certain strike price on the building. And even after I go in and renovate every single unit and get the rent up on every single unit, I still get to buy it for that relative strike price. And March 2026 is when I have to buy the building. So it's coming up.
So it's 2 years?
2 years. So we're kind of getting close to our first full cycle. And the revenue was at about $13,000. and the NOI was at about zero when I took it over. I've put about $75,000 into the building for construction, and I get to buy the building for $79,000 a unit on March 1st, 2026. And that building has a revenue of $24,000 now and an NOI of about $15,000 per month. And I'm going to be buying that building at around a 14.5 cap going in, which is ludicrous.
So how much value have you created from the time you executed the master lease to present day?
About
Would you estimate?
$850,000.
Okay, so you've created about 850,000, and then you're gonna be buying it for what, roughly like 1.4, something like that?
1.389.
1.389. So I mean, that's almost what, 60-70% of value creation right there. So huge for you. And obviously it's a great strategy. Something that was harder to do in previous years because most people would have just sold it to another buyer and they wanted straightforward deals. We are starting to see things change where people are more open to creative financing. Talk to us about that, because when you execute the master lease, the belief or I guess my assumption then is the seller probably didn't have another offer that they loved, or they would have just turned around and sold it to somebody else for the same price point, right? So what do you think made them comfortable with the master lease agreement, and what were you under contract to buy it for to, at that time you executed the master lease?
Yeah. So those are good questions. I mean, one of the critical things about the master lease that is a beautiful part of it, if you can find the right deal, is the equity increase over time is a net equity increase. So I'm actually benefiting on their debt just by paying down the principal. It's actually contributing roughly 60% of that equity increase over time. So that's something to note right there. And that's a very key piece of leverage. And then I'm the agent. So I'm also waiving buying and selling fees, which on a multifamily transaction of that size is 4.5 to 6%. Now, if you're doing it based on asset value and it's highly leveraged and the equity value, instead of it being, let's say, 6% of the transaction because it's leveraged up to 80%, you times 6 by 5, it's actually 30% of the equity value to have an agent involved. So not only are they getting a 30% return on their equity value, but they're getting another 30% return by not having an agent. Like, working in different components of that. And then I think I'm digressing a little bit on your original question.
But I think you just hit on a couple of things though, right? And this is where you create value. Because you are an agent, you are representing the owner, and clearly you made an offer that he or she was comfortable with. So because of that, though, you can start to understand how you're saving money for that owner, right? Now you waived your commission, you're able to come in and structure the deal in a certain way. And then for you, because you can buy it, or do the master lease agreement, you're getting not just the equity you're creating and forcing through appreciation, but you're also doing the debt pay down. So you have a couple of different ways where you're creating value on this deal. So for those folks who have been interested in master lease agreements and creative financing, what are some of the things they should look for to identify whether or not an owner is going to be open to it?
So, and we don't probably have time to get into this right now, but we run a full-fledged real estate agent team now. And we're, that's one of the best parts about our business. So I was having a conversation with an agent who's amazing, but just needed a little coaching. And it's like, lead with value, especially, he's in commercial. We do a lot of commercial, like warehouse, and you're calling this guy, he owns 200,000 square feet of commercial real estate. And like, not to sound crass, but like, he's giving this random kid time. Why should he give you time? And it's because you're leading with value. Hey, I saw this, I can make an OM. Like, you have experiential value or you have time value. And you don't have much experiential value. No offense. So lead with time value. What can you do? I can call every single owner around this building, and I can ask them if they would be open to buying because of the marketing materials I put together and my pitch. And this will take me 70 hours to do, but I'll do it for you for free if you just give me a shot. So that, kind of translates, what's your value? My value from day one is I ran a property management company that specialized in kind of low income and Section 8 rentals. And they don't have to go through a due diligence period. They don't have to go through, inspection. They don't have to go through anything. Day one, I can take this over. I can take this over in, 24 hours if you just sign on the dotted line on my legal docs that I've sent to you earlier this morning. That time and the reducing of a headache is the biggest value possible. The GP on the project had a bunch of other stuff going on. Successful guy. He's like, this is my least favorite thing to spend time on. And you're saying that you can give my investors like a 47% return on their investment and I never have to look at this thing again? Boom. That's a immediate time takeover value is the first thing. And then the second thing is like, leverage or like skin in the game or like making sure that there's less risk. If you're asking somebody if they can send you a financial sheet, and this is going back to the agent conversation, send you a financial sheet and you can create all this stuff and call a bunch of people for them, you're sending financials to somebody you don't necessarily know. There's a little bit of risk. But if you call somebody and it's like, hey, can I list your building? Like you're letting somebody have full like listing rights and you have to pay them and they get access to your building. Like that's a decent amount of risk before you've proven yourself. So on the flip side of the master lease, like you're putting zero money down. What's your skin in the game? Where is our risk mitigation? And one of the things was, if I don't buy the building, I'll pay for all the construction. If I don't buy the building, you just get it back. I will run this project and I will do all of the construction. Here's my previous kind of portfolio, my resume. It's good construction. I'll give it to you for free. You get a building back that, okay, maybe you wanted to sell it, but now it's probably worth, a bunch more money. So you're not mad. And I didn't cross collateralize anything. I didn't, I'm a little surprised that they gave me the opportunity with the risk, but I was somewhat established already. I had a property management company. I had a track record of taking projects, getting them where it needed to be. And the value prop was so high that maybe my skin in the game or my risk could be lower because it's all just a bunch of levers. And if the value lever is really high, then you can pull the risk lever a little bit down.
Yeah, a couple of things you said that stood out. One is just understanding, first of all, like how do you solve the challenge for that homeowner or that property owner? You talked about the time, right? Just being able to come in and say, hey, we can sign these papers and we can take over today. For someone who is done managing a property, especially they're self-managing, and if you're telling them you can take over today or tomorrow, man, that's got to feel good. I don't have to sit here and wait for this long 60, 90-day closing process and everything else. Like I can throw my hands up and somebody else is dealing with this property tonight. That is intriguing for many property owners, particularly for those problem child properties. And in this case, you talked about this being really the worst one he had in his portfolio, where he said, hey, you want to give it a shot? Try it on this one. Was that the same property you had under contract, or is this a different property he had in his portfolio?
Same owner, different property.
Yeah. So I think that's another intriguing thing too, right? Real estate investors are real estate investors. Typically, you own multiple properties, and there may be one or two properties that you look to sell because they're the darlings and they're going to make the most money, and we've done it, right? But there might be one or two others where it's like, man, I can't sell these. Like they're terrible. They're not cash flowing, and they may want to sell. They may be done with them, but they're not in a position to take it to market. But you have to ask, right? You have to ask those questions, and maybe there's an opportunity. And I think the lesson here for all of our listeners, is when you have an opportunity to build a connection with an owner, even if it's about one property, always ask what else is in their portfolio. Ask them if there's anything keeping them up at night, because I promise you, every investor I know, they have at least one property that's not performing up to the level that they expected. Doesn't necessarily have to be a loser or anything like that. But it may not be meeting their expectations, and maybe they're not able to invest the money they want or the time they want on that property. But again, maybe they don't want to sell it either for various reasons. So a master lease could be a nice solution. Can you talk to us just a little bit more on any other tips or tricks you've learned on building that rapport with homeowners or property owners?
Yeah. And I think you kind of alluded it when you were talking there, but my time value, the value of my time in pure monetary, form, and we're getting a little bit meta, but was substantially lower than this owner's value of his time. We're both human beings. I'm not talking about like the value of who we are. I'm just saying my time can produce less monetary compensation in that moment than his time could produce monetary compensation. So if I can create a strong enough value prop and show him that like I'm not a big risk, let me push my time into something that you just are not willing to and still get you a return, still make it worth your while. As you scale and grow larger and larger and larger, I think this principle only compounds. We've taken over buildings at a much like larger scope on this same phenomenon from a private equity group out of California now. And we're having these conversations and, I'm talking about raising a fund myself. And like these guys have money that fundamentally, 5 or 6 years ago wouldn't have really made sense to me. But because they could potentially place some of this capital in my private equity fund and I can work harder at it, I can push more of my time into it, it will have a higher value than what they're willing to push time into. We might not be able to push as much money into my system right now, but it will have a higher return because I'm willing to push more time into it right now. So I might be getting a shot at an even bigger opportunity because I'm proving that I'm willing to spend the time and I'm willing to do it on a product that you might not be willing to spend the time on or a system that you might not be willing to spend the time on, but you're going to give me some resources to be able to make it happen for me.
No, I love it. And that's it, right? Just our time is valuable. And for some of us, that time is just viewed differently when, we all have our relationships with our properties and we know what we've gone through. And listen, what's a great opportunity for you, maybe someone else's headache, and they're just done with it. And I remember starting out as an investor and I would always wonder why people didn't do more to their properties. It's like, oh, you can do X, Y, Z. How come you guys haven't done it? Right. And you just learn to realize, like, for some people, if you bought a property at a great basis, you're already getting great value. So it's like, well, why would I spend another $50,000 just to redo the kitchen if I'm already cash flowing X amount of dollars a month? They're not going to, right? But for you as a new investor, you see the opportunity. And that's the beauty. And in commercial real estate, this is also one of the reasons they talk about properties trading, right? Not selling, because there's no intention of holding these things forever, at least generally speaking. People recognize that, hey, there's going to be a point in time where there is going to be an offer or an opportunity that we want to pursue, where we may release this asset and we'll go buy another asset. And that's just part of it. And it just really helps the mindset to think about your time, what you can invest in, but also your time based on your own experiences. You may be able to do something very, very quickly or see an opportunity and be able to execute in a snap of a finger. Whereas that owner, it may take them weeks, if not months, to deliver or be able to move on that same thing. I mean, just think about the network you have to be able to go and call a contractor, get a plumber, get a quote. Like for some people, That's a lot of work. And you're like, oh man, I don't even know anybody. I got to go research. I'm good. And you may have a guy on speed dial. You just shoot a little text and he's going to come over and have all that done for you by the afternoon. So it really just depends on who you are and your super skills and where you have an unfair advantage. And if you have that, this could be a phenomenal strategy for you to continue to build and grow. Hey, James, we've talked a lot about how you've been able to build your business. Congratulations on that. I really appreciate the pivot you've been able to make. And I think it's great for our listeners just to understand, hey, just because you woke up one day wherever you're at doesn't mean you have to stay on that path. You can step back and say, all right, how did I get here? What do I need to do different? And what adjustments do I need to make? Make sure you're always taking a look at your business and where you're headed so you can course correct when and if necessary. James, for folks that want to learn more, what's the best way for them to get in touch with you?
I think, and I chose this name when I was in college, and we've just kept it.
I have no idea what you're about to say, but the way you're setting this up, I'm going worst case scenario here. So
yeah, so bear with me.
I have to get our editor ready to go to clean this one up. But go ahead.
But our holding company's name is called Verus Praedium Holding, and that's Verus Praediumholding. It's a little bit of a mouthful. But we have a website. It has a link to all of our operational companies: Revolution Renting, Revolution Investing, Revolution Construction, and Revolution Realty. If you're ever in the Twin Cities, we office at Uptown Minneapolis. We're happy to give you a tour, and we love to meet new people who are doing really interesting things. And we're growing really fast. So if you're interested in real estate and you're in the Twin Cities or you're moving to the Twin Cities, we'd love to have you on the team.
James, I appreciate you sharing that, man. We'll make sure we link to that in the show notes. Pleasure talking to you today. Looking forward to staying in touch, and I hope you have a great one. Hey, best ever listeners, hope you enjoyed this conversation today. If you got a little bit of value, make sure you let us know about it. Give us some honest feedback with the rating and review, and share this episode with someone else you think could get some value out of it. For all of our great folks today, for James, for myself, and all the rest of the best ever podcast hosts, I want to thank you for checking us out today. Make sure you stay listening, stay subscribed, and keep growing your portfolio. Take care until next time.